Hello there. Welcome back to Cost and Management Accounting L5. So this video, I want to look at the preparation of the production cost statement. So we're given our question, which is our question 6, from the question paper of June 2025. So the question reads that the following information was taken from the books of Whatever Private Limited. They were given opening balances. So you'd see that information given at the beginning represents our opening balance. And then the given transactions during the year is a list of those transactions. Then I believe that you are given additional information. Then on the required part, the first part requires us to prepare the production cost statement for the year ended 31 March 2024 with 19 marks. So we are going to have our production cost statement of Whatever Private Limited. So in that case, we are going to start with our calculation of the cost of direct materials. So we're going to have a heading of direct materials. So on direct materials, obviously we are going to start with our opening stock. That is stock uh, on the day of the beginning of the year. That is on 1 April 2023. So stock on 1 April 2023. So direct materials, we are going to have our stock. We are saying 1 April 2023. So 01 04 2023 is indicated as our debt, as our opening balance. And of course, direct materials, we've got an opening balance of 94,000. Then from there, you're supposed to add your purchases, that is plus purchases. So for purchases, we check what figure do we have in terms of purchases. So if you go down, you'd see that we have got 195,900 is our material received from suppliers, representing our purchases. So remember, we are supposed to put our net purchase figure. If we have got any returns of purchases, we are supposed to subtract them. So if you check, we have got material return to supplier. So these are purchase returns of 10,000. So we subtract 10,000 from 195,900 in brackets. We have 195,900 minus 10,000. And we get 185,900. Then from there, we see in terms of the addition of 94,000 plus 185,900 to get the figure for stock available for use. So here we are supposed to have stock available for use. And of course, 184,000 plus 185,900, we're going to get 279,900. And of course, we can show that there was an addition which took place. Then from there, we move on to the next part whereby we are going to subtract stock at the end. So we are saying less stock. Then our date is 31 March 2024, 31 03 2024. So we have an amount of 76,400. So we are saying less, so we can show by putting brackets that we are subtracting. So with that, we can underline to say 279,900 minus 76,400, and you're going to get your answer is 203,500, which is going to come in the other column. Yeah, the figure that we got now becomes the raw materials used or direct materials used. So with that, we move on to the next part whereby we are supposed to identify our direct labor. So for direct labor, we check again according to the list of balances that we are given. You see that we are given direct labor of we are given direct factor wages is 185,600. So this is our direct labor, 185,600 is our direct factor wages. So this is going to represent our direct labor. So we have 185,600. So with that, remember, if you say direct direct materials plus direct labor, you are going to get your prime cost. So here we have prime cost, and of course, we're going to make an addition. So if you add 203,500 plus 185,600, you get your prime cost, which is 398,100. So going forward, you'd see that now from prime costs, you are supposed to move on to manufacturing overheads are recovered. Manufacturing overheads are recovered. And of course, manufacturing overheads recovered, we get it the amount in the question. So if you go to additional information, we are given that manufacturing overheads recovered during the year amounted to 482,300 rand. So this is the figure for manufacturing overheads recovered. $482,300. And of course, beneath that, we now list all the manufacturing overheads that we have in the question and compare with this figure that we have here to see if there's an over recovery or an under recovery. So with that, we check which ones do we have. So if you go to the question, we see that we have got a salary of the production manager, which is part of overheads. We have got 140,000. So we are saying salary. Production manager. 140,000. The next what do we have? We have got factory rent. It's also part of that. We have an amount of 54,000. Factory rent 54,000. So 145,000 is 140,000 is our production manager. We are supposed to put it in this column, in the first column here. So we are saying 140,000 And then this factor rent, we got it as 54,000. So we put it again here, and then we list all the manufacturing overheads in the first column. Then after factor rent, I will check again which one we have next. We have got a factory electricity. We do have factory electricity, which is can try to check which figure do we have. Factory electricity is 44,200. For 4,200. And then we check in terms of others that we have. Of course, we can talk about factory insurance, 13,700. That 8,700. And then we check after factory insurance. So we have got also factory rates and taxes. Factory rates and taxes, 32,300. Thirty-two thousand 300. And then from there, we check again. So we have got also water factory, 20,950. Water factory. And we got 28,950. And then, of course, we are checking only manufacturing overheads. So from there, we are supposed also to check in terms of depreciation. So you see that we are given depreciation is a depreciation of factory equipment 15% per annum according to the cost price method. Remember, the formula for cost price is percentage times cost. So basically, we're given the percentage is 15%. Then the cost price is just above. We're given this 450,600. So we calculate, we multiply it by 15%. So we are saying 450,600 times 15%. And we are going to get it as 67,590, which again we are going to put as our depreciation. Depreciation factory equipment. So that's what we have. And then the figure that we got is 67,590. So that's what we have on that part. So we are supposed to add all the overheads from 140,000 down to 67,590 to get the figure for total actual overheads. So here we are supposed to have total actual overheads. So total actual overheads, if you add, you're going to get a total of 405,000. 105,740. And of course, this total, you're supposed to compare it with the manufacturing overheads recovered. So to check which one is greater, so it is that manufacturing overheads recovered is greater than the total actual overheads. So we have such a scenario, it means we have an over recovery. So here we are going to say plus over recovered manufacturing overheads. Plus over recovered manufacturing overheads. So we find the difference by saying 482,300 minus 405,740, and we get 76,560. Remember, we are supposed to carry this in the trading account under cost of sales, and we're going to show it as a negative. So that is what we have. So with that, it means we are going to use our figure for manufacturing overheads recovered as part of the calculation to arrive at the cost of production of finished goods. So we're now going to say prime cost plus manufacturing overheads, 319,100 plus 482,300. Then we get our total figure, which is supposed to come here is our total cost of production. So we get 880. 880,400. And this is total cost of production. So beneath that, we are supposed now to go to addition of work in process. So we say we add work in process. Add work in process at the beginning. At the beginning, we have got a value of work in progress 62,000, which is 010423. And the figure that we have is 62,000. And then we were supposed to add that figure to our total cost of production. So we add it to total cost of production. You get 942,400. And then we less closing work in process. So this is work in process. Date is 81 March 2024 with an amount of 50,500. We check. We have got an amount of 50,500. 500. So we have 50,500, and we are saying less, so we are subtracting, we put brackets. Then in terms of the date, remember it's date 1, 3104, 2024, date 103, 2024. And we calculate it there to arrive at the final figure, which is going to be cost of production of finished goods. Cost of production of finished goods. So 942,400 minus 50,500, you get 891,900. So this becomes the final figure that is supposed to be transferred. To the trading account under cost of sales. So Basically, this is what we have. And then as a continuation, we also have the statement of comprehensive income, which we are supposed to start with your, obviously, we are going to start with the revenue figure, which is our sales figure. So we check according to the question, what figure for sales do we have? So if you come here, you see that we've got 1,550,000 is our sales. So we indicate it as our sales. $1,550,000. And then from there, we go to less. Less cost of sales. Then on less cost of sales, we are supposed to calculate the cost of sales. I will start with stock of finished goods. That is opening balance of stock of finished goods. So we're saying stock of finished goods. And the date is supposed to be 01 04 2023. 01 04 2023. And we check in terms of the open stock of finished goods that we're given it is 48,500. 48,500. And then from there, we are supposed to add cost of production. So our cost of production, we've calculated it here, and we've got 891,900. So we are saying 800 and then 1,900. So after adding our cost of production, we are supposed to less the over recovered. Remember, we have got we identified an over recovered manufacturing overheads, which we are supposed to carry again and subtract it here in the treasury account. So we are saying less over recovered manufacturing overheads. Over recovered manufacturing overheads. And the figure that we got is 76,560. So we can show it in brackets. So with that, we can rule off to calculate. So if you say 48,500 plus 891,900 minus 76,560, you get your figure is 863,840. And these are finished goods available. And of course, you now less finished goods at the end. Less finished goods. And the date now is 31/03/24. And we check in terms of that balance, which we are given is 28,500. So subtract it. So with that now, we are supposed to close so that we calculate the final figure for our cost of sales. So we are now saying 863,840 minus 20,500. And then we get a figure for our cost of sales is 835,000. 835,340. And we can show it in brackets to show that we are subtracting. So that's what we have on that part. So with that, we calculate our gross profit by saying sales minus cost of sales. Then we get our gross profit. And we get our gross profit is 714,660. Which means we also have to so after gross profit, we are supposed to less any expenses that we see in the question. We check in terms of other expenses that are not production expenses. Of course, we have salary marketing department manager 69,400. So we are saying salary marketing manager in the amount that we have is 69,400. And we're supposed to subtract it from our gross profit. And then in terms of the next expense after that one, we have marketing costs 38,400. I will subtract it again. And of course, we calculate to get the net profit. So we say 714,760 minus 69,400 minus 30,400, and we get our net profit. Net profit before tax. Net profit before tax is 606,860. And then from there, we are supposed to calculate our income tax. So we're saying less income tax. So for income tax, we check what is the question saying. So income tax is being said is calculated at 28%. 28%. So we are saying 28% times 606,860. So this we calculate it by 28%. So we multiply this by 28%. And then the figure that we are supposed to get there for tax is 169,921. 921. And we are subtracting it to get to the final figure. The final figure becomes net profit after tax. So 606,860 minus 169,921, you get 436,939. So this becomes your final figure for net profit after tax. So this is what we've guys. Thank you for listening, and hopefully the video was helpful. And let's not forget to subscribe and share the link to our colleagues who are doing cost and management accounting L5. Let's meet again in the next video.